Everyone. Today I'd like to explain to friends, family, and really everybody that's not really familiar with multifamily syndication what my partners and I do when we put deals together. So, in real estate, as well as just about any industry, really, a syndication is when a group of people or companies put their resources together, whether it be time, money, or expertise, to achieve a goal that would be difficult for each company or person to do on their own. For investors, this is a very effective way to pool their financial and intellectual resources together to invest in projects much bigger than they can buy and run themselves. So, as it relates to multifamily, when you invest with a syndicator, you own a percentage of that property along with other investors in that deal. This means that the great benefits such as accelerated depreciation and preservation of capital and things like that are all enjoyed by the investors in the deal as a whole. There are many types of real estate syndication deals. You can join a syndication that, say, puts up some new construction, a new building or something like that. There's cash flow deals where you cash flow the deal and then maybe it's somebody that wants to make an exit after running it for a certain amount of time. Or even a value add, which is what my partners and I specialize in. This mainly consists of forcing the appreciation of the property by driving net NOI. And this could also mean cutting expenses and reducing income. Basically, that's the formula. In these types of scenarios, there are typically properties that have fallen prey to mismanagement. They have some deferred maintenance, or they have some really big upside where the property can be repositioned. In any case, a value add property, the ones that we target, are all cash flow deals. We're not buying deals for appreciation. So I've released materials on this as well. I've included the links in the description, so check that out so you can understand what I mean by cash flow versus appreciation. Now, you may be wondering, how does a syndication actually work? To get to that, let me talk about the three main participants of a syndication deal. The people putting the deal together, they're called a deal sponsor. They're also referred to as the general partnership, the syndicator, or the operator. So that's number one. The second one is the passive investors, known as the limited partners. All right, and then the final part is the property management team that works with the operators to make sure that the property is being run well. Aside from that structure, there are many other supporting functions that go to work to put the entire structure together, like the lender, the SEC attorney, the real estate broker, the accountant, title companies, and many, many others that really help put everything together. While there are many players and many moving parts, the deal sponsor is the one that really is the key to it all. They need to identify the market, work with the lender to get the financing locked in, execute the business plan, make sure the renovations are getting done, staying in constant contact with property management, and of course, keeping the investors up to date as to how things are going with the property. The limited partners or the investors, they provide the equity in the deal, meaning they're coming up with the cash, right? They are bringing the money to the table to get that deal done. These people are typically accredited investors and they don't have any day to day operational responsibility. Rather, they rely on the deal sponsor to make sure that they are doing what they say they're going to do for the return that they targeted when they first funded the deal. Now, with all that said, they usually have very limited decision making in the operation of the property, which reduces their personal liability if a lawsuit crops up or something bad happens. Additionally, they are not on the banknote, so if things go very bad for the property, their exposure is only limited to what they originally invested, not the entire amount of the property itself. And again, typically, syndicators, they know what they're doing, so it doesn't happen very often when these properties totally go really really bad. The property management group is vital to the overall success of the deal. A strong management group knows the local area, they know the market's strengths and weaknesses, and they know how to fill those units with quality tenants. They are also great at running teams of renovators and making sure the tenants are kept happy where they live. This group works closely with the deal sponsor. in not only running the deal, but also identifying opportunities, and assisting in the underwriting and working on due diligence and really onboarding that property when they first acquire it. And by that, I mean they really assist with taking on if there's any Section 8 tenants that need to be straightened out beforehand, and putting it into the system. So let's recap. So far, you've learned about what a syndication deal is and its benefits. You learned the three types of deals, but there's many more that you're able to participate in, and who the deal sponsors are, and the syndicators and limited partners and the property management. You know about that now. So when it comes to the overall deal strategy, there are four main parts. There's the market, the asset itself, the business plan, and the deal exit strategy. Four pieces. The first part of any value add strategy is the definition of the market. A typical market is a nice high growth MSA, a metropolitan statistical area, with above average job growth, a growing population, and employer diversification. The sponsor will also look at how the market rents are growing without any major renovations, um, as the number of new units coming online also will affect how things roll and their absorption into the marketplace, meaning how fast are they getting snipped up by these other tenants. All this is indicative of a very good market. Once the market's been identified, the search is now on to try to find a good asset. For many, they're looking for stabilized property with conservative underwriting with room left for a value add play rather. Um, Perhaps the deal is operating at 82% occupancy. The expenses are super high, but the roof, the mechanicals, the foundation of the property are still in good shape. This sort of deal provides the least amount of risk. The very best deal, of course, is one that has this property that isn't so old, doesn't require much work, and would kill the budget if you exceed the cost per unit to repair the thing. But those deals typically go for a lot more money because of the condition that they're in, the better condition. So once the property is selected, due diligence is performed. This includes a deep review of the physical property that usually covers everything from the roof all the way, the individual units, the walls, and all the way down to the boiler and the electrical system in the basement. You want to make sure that everything is in top shape and there's no items that can throw the deal off, like say a Federal Pacific breakers and aluminum wiring. That's usually not a really good sign. Aside from the physical, you have to get the accountant to review the financials and verify that the rent income lines up with what's being reported in the statements, provided that the bank and management company gave you good information. Usually the deal is cash flowing and there's enough actual income from the deal to support the bank note and the expenses. This is what any good deal sponsor is going to underwrite on. They will base the numbers off of what they have today and not what may happen in the future. Sure, you can create a model of possibility, but this is not what you want to submit to the bank. Rather, you want the model of possibility to become part of the business plan, which we're going to discuss here in a second. So, after the letter of intent, the LOI, and the purchase agreement, and you close it, now it's time to now you have to execute the business plan. And in this case, the plan is created by not only what you found during due diligence, but also what you've seen in the competitive landscape. The ultimate goal is to increase the NOI, the net operating income, by increasing income and reducing expenses. Simple formula. You know, this will include, like, say, doing interior renovations to get more rent, rebranding the property, adding amenities such as reserved parking or coin-operated laundry and vending. Those are all great ways of doing that. Other considerations will also be to improve the overall tenant experience, like giving tenants a small gift basket when they move in, and 24-hour support if they have a problem in the middle of the night. Reducing the expenses is the other lever you can pull to boost NOI. This can be done by hiring new property management, getting, say, new insurance, or installing technology that would provide or improve boiler efficiency if you're paying the heat as a landlord. The deal sponsor tracks all the improvements, not only for the accountant, but also to inform the investors of how the property is progressing. You want to show that things are happening. And as the business plan is executed and the property is stabilized, The deal is held for as long as it's been defined in the by the by the investors uh, before the deal exit strategy. So typically there's a 10-year hold with a 3 to 5 year refi to return at least 60% of the investor's initial contribution while still holding equity in the deal. All right. The return depends on where the market cycle is, whether it's growth and recession, either one of those two, and if it makes sense to sell a refi. All that will drive the decision as to when you want to refinance the property. Once the business plan is executed, this is where the deal sponsor and limited partners cash out and everybody wins. And if the property and the deal sponsor perform to make the deal a success, everybody's going to walk away with a nice bunch of cash. Now, how do the syndicators make money in all this? Well, the deal sponsor, they make income from the predefined split with the limited partners. This split varies on deal to deal, right? It depends on the deal sponsor's background. So there's also an acquisition and asset management fee as well that goes along with it. And it's a fee for landing and launching the deal as well as the ongoing management of the deal itself. The sponsor's main component of income from a deal syndication is the split with the limited partners. So depending on the operator, you may see a straight split or with something that's called a waterfall structure. Some deals sponsors, they have like a 70-30 split in favor of the limited partners, plus a 9% preferred cash on cash return. Not a bad deal. Both the deal sponsors and limited partners, they have equity in the deal for the entire life of the syndication, right? So if you go through multiple refis, money's pulled out by everyone. A second form of revenue for the deal sponsor comes in two forms of two fees, right? An acquisition fee and asset management fee. The deal sponsor will receive the acquisition fee, which is a percentage of the property price paid to the sponsor at the time of closing, while the asset management fee is an ongoing fee that the sponsor collects for the daily activities and overseeing the management of the asset. It's common to see a 2% rate for each of these fees. All these splits and the rates, they all vary by deal sponsor. It really depends on the sponsor, the market, and the opportunity itself. So all these different drivers will affect how that split actually works. Anyway, this is meant to be a very high level view of a syndication setup, the groups involved and how money is made on a deal. Are you syndicating deals today? How does your breakdown work? Let me know in the comments. I'd love to hear from you. And if you like this content, go ahead and give it a thumbs up and share it. Also, check out the Bulletproof Cash Flow podcast on iTunes and Stitcher, and subscribe to the YouTube channel as well. We're working on getting new content out to you guys every day and really help you build success in the world of multifamily. So be great, guys, and I'll talk to you again soon.